I think it's very hard to come up with a persuasive case that equities will, over the next 17 years, perform anything like they've performed in the past 17.
In 1999, Warren Buffett made a bold prediction. The stock market, which had been surging at an incredible pace, would experience a prolonged period of sluggish growth. He was right. Over the next 17 years, the market delivered a meager 2.5% annual return. What's striking is that the same factors Buffett highlighted as indicators of weak future stock performance are flashing warnings again today. Interestingly, Buffett has been selling a significant amount of stock in 2024, holding the largest cash allocation of his career. If the market were to crash, as it did shortly after his 1999 Fortune article, he would be well-positioned to take advantage of the downturn. To understand his perspective, let's examine the 17-year period from 1965 to 1982. While this may seem like a random time frame, it provides valuable insights. During these years, the S&P 500 rose from 85 points to just 141 points, a modest 66% gain. However, when adjusted for inflation, the picture worsens. The high inflation of the 1970s and early 1980s nearly tripled the cost of goods and services. For example, $10,000 invested in the stock market in 1965 would grow to about $16,600 by 1982. But the goods that $10,000 could buy in 1965 would cost approximately $30,000 by 1982. Adjusted for inflation, real wealth declined by 50% during this period. Surprisingly, this wasn't due to poor economic performance. The U.S. GDP surged from $697 billion to $3.4 trillion, a nearly 400% increase, and corporate profits grew by almost 300%. Buffett used this period as a key case study in his Fortune article, noting how the Dow Jones Industrial Average remained virtually flat despite robust economic and profit growth. This disconnect highlights how market sentiment, rather than economic fundamentals, can heavily influence stock performance. During that same 17 years, the GDP of the U.S., that is the business being done in the country, almost quintupled, rising by 370%. Or if we look at another measure, the sales of the Fortune 500 more than sextupled. And yet the Dow went exactly nowhere. This period serves as a striking example of how the stock market can lose alignment with the actual value of the businesses it represents. When investors become overly optimistic, they tend to drive stock prices up too quickly. Buffett highlights two key factors that explain the prolonged weakness in stock returns during such times. These same factors provide valuable insights into the current state of the market and what we might anticipate in the future. The first is interest rates. These act on financial valuations the way gravity acts on matter. The higher the rate, the greater the downward pull. All investment opportunities, whether in stocks, bonds, or property, are evaluated relative to one another based on the cash they can deliver in the future. Since the future is uncertain, investors also consider the likelihood of receiving these cash flows, essentially assessing the risk involved. At the safest end of the spectrum are U.S. government bonds, which provide near risk-free returns. These bonds explicitly state the cash flows they will pay, and the U.S. government has a flawless record of honoring these payments. As a result, government bonds serve as a benchmark for other investments. For example, if a government bond offers a 3% risk-free return, investors would require at least a 3% return from stocks to make them worthwhile. As the risk-free rate rises or falls, so do the returns demanded from stocks. During the 1965 to 1982 period, interest rates rose significantly, from 4.3% to 8.9%. This increase meant investors could earn substantially higher returns from risk-free government bonds, leading them to demand higher returns from stocks. Consequently, stock prices dropped relative to profits, contributing to weak market performance. In contrast, from 1982 to 1999, interest rates fell from 8.9% to 5.3%, sparking a dramatic rise in the S&P 500 from 141 points to 1,469, a 942% increase. While there was considerable inflation during this period, the stock market still grew more than sixfold after adjusting for inflation. This stark contrast highlights the powerful influence of interest rate trends on market performance. The increase in equity value since 1981 beats anything you can find in history. This increase even surpasses what you would have realized if you bought stocks in 1932. At the Depression bottom. Sharp changes in interest rates are undoubtedly a highly relevant factor in 2024, but they are only the first variable Buffett addresses. The second is corporate profits, which he evaluates as a percentage of the U.S. GDP. In effect, what this chart tells you is what proportion of GDP ended up every year with the shareholders of American business. The share of everything produced in the U.S. that goes to stock market investors, corporate profits as a percentage of GDP, has a significant impact on investor sentiment and, consequently, stock prices. In 1965, corporate profits accounted for 6.5% of GDP, but by the early 1980s, this figure had dropped to a low of 3.5%. During this period, high interest rates provided an attractive, risk-free alternative to stocks, while corporate profits grew at a slower pace than the broader economy. And as is so typical, investors projected out into the future what they were seeing. That's their unshakable habit, looking in the rear-view mirror instead of through the windshield. Between 1982 and 1999, the U.S. GDP grew from $3.3 trillion to $9.9 trillion, marking a 191% increase, while corporate profits rose by 243%. Despite this slower growth compared to the previous 17 years, stock market returns were remarkably stronger. To summarize Buffett's key insight, large swings in interest rates significantly influence stock market performance. Additionally, stock returns are shaped by corporate profit trends, as investors often project recent profit strength or weakness into the future. A common but flawed tendency. This brings us to Buffett's 1999 prediction, which remains relevant today. At the time, the stock market had soared nearly tenfold since 1982, fueling investor optimism. By applying his reasoning to current data, we can better understand the potential trajectory of today's markets. Most investors have rosy expectations. Even those who have invested for more than 20 years are expecting 12.9% per year returns. Buffett believed it was highly likely that stock market returns would remain significantly weak during the 17-year period from 1999 to 2016. Today, if an investor is to achieve juicy profits in the market over 10 years or 17 or 20, one or more of three things must happen. The first was that interest rates must fall further. From the 6% level at the time, something Buffett thought was unlikely. The second was corporate profitability in relation to GDP must rise. At the time, corporate profits in the U.S. stood at $591 billion, roughly 6% of the $9.9 trillion GDP, a level consistent with historical averages, as corporate profits have typically grown in line with nominal GDP over the long term. For investors to expect a 30% annual return in a scenario where interest rates remain steady, corporate profits would need to claim a significantly larger share of GDP. Alternatively, GDP would have to grow at double-digit rates, which is highly unlikely for clear and practical reasons. Buffett wrote, "In my opinion, you have to be wildly optimistic to believe that corporate profits as a percentage of GDP can for any sustained period hold much above 6%. He provided two reasons for this. The first is competition. If many businesses are competing for a share of the profit pie in the U.S., it's unlikely that profits can grow at a rate higher than GDP for an extended period. The other factor is public policy. If corporate investors in aggregate are going to eat an ever-growing portion of the American economic pie, some other groups would have to settle for a smaller portion. That would justifiably raise political problems, and in my view, a major reslicing of the pie just isn't going to happen." So what actually happened after 1999? Well, Buffett was wrong about interest rates. They continued to decline, eventually reaching nearly 0% by 2016. However, he was right about corporate profits. Over the 17-year period, S&P 500 earnings doubled, and nominal GDP also grew. As a result, the proportion of profits from S&P 500 companies relative to the overall economy remained stable. Despite the doubling of corporate profits and the significant drop in interest rates, the stock market saw little growth. The S&P 500 only rose by 52%, but after adjusting for inflation, that was just a 6.3% total increase over 17 years. The stock market had become so egregiously overvalued in the late 90s that even with interest rate cuts and strong corporate profits, it didn't see substantial gains. In 1999, stock prices were around 30 times the earnings of companies, which decreased to 24 times earnings by 2016. While still higher than historical averages, this valuation was enough to result in weak stock returns for over a decade. This is particularly relevant today, as the S&P 500's price-to-earnings ratio is once again around 30. Strong corporate profits have led to optimistic expectations for future growth. Since 2016, S&P 500 earnings have more than doubled, while nominal GDP has only increased by 50%. Interest rates have also risen significantly, returning to levels similar to those in 1999. Looking ahead, if trends play out similarly to Buffett's 1999 prediction, nominal GDP growth is expected to be about 4.5% per year. If corporate profits grow at the same rate, S&P 500 earnings could reach about $312 per share in 10 years. However, if the price-to-earnings ratio contracts from 30 to 24, as it did between 1999 and 2016, the S&P 500 could be at approximately 7,490 points, resulting in a weak 10-year period with little real return, assuming inflation is about 2% per year. A key factor for stock returns in the next decade will be whether the current P/E ratio of 30 contracts back to historical norms. The P/E ratio decreased from 1999 to 2016 because investor sentiment around profit growth shifted, with earnings growing in line with GDP rather than expectations of higher growth. While lower interest rates could provide a tailwind for stocks, there's no certainty that they will prevent weak returns, nor any guarantee that interest rates will fall. We might even face a scenario where interest rates remain at current levels, which have historically averaged around these rates. If corporate profits rise at 4.5% per year, in line with GDP growth, but the price-to-earnings (P/E) ratio of the S&P 500 contracts to its long-run average of 15, the index could fall below 4,700 points in 10 years, nearly 20% lower than its current level. However, a more optimistic scenario could unfold if the P/E ratio remains at its current level of around 30. In this case, stock returns would closely mirror the growth in profits and dividends of S&P 500 companies. To achieve a 15% annual return, as the market has in recent years, profits would need to rise at double-digit rates. While this is uncertain and historically unusual, it would require corporate profits as a percentage of GDP to reach unprecedented levels, something Buffett doubts is realistic. Even if stock returns are likely to be weaker than in recent years, this shouldn't significantly alter your investment strategy. The key takeaway is that you should only invest in stocks you are prepared to hold long-term. Buffett himself, heavily invested in cash, makes decisions based on individual stock valuations, not broad market predictions. This approach contrasts with index investing, which simply aims to mirror market returns consistently. Buffett's approach to investing, as outlined in his 1999 article, reflects this mindset clearly. Though I will be talking about the level of the market, I will not be predicting its next moves. At Berkshire, we focus almost exclusively on the valuation of individual companies, looking only to a very limited extent at the valuation of the overall market. Even then, valuing the market has nothing to do with where it's going to go in the next week, month, or next year. We'd love to hear your thoughts in the comments if this video resonates with you. Don't forget to join our community by subscribing to our channel and turning on notifications with the bell icon. Thank you for being a valued member of our community.